Welcome back to the Deep Dive. Today we're taking a close look at one of India's real financial heavyweights, UTI Asset Management Company.
Yeah, a foundational player.
Exactly.
Yeah.
We've got their Q2 and half-year results for FY26 right here, but we're not just, reading off the numbers.
Yeah, definitely not. Our mission today is really to get behind those figures because there's this interesting paradox, isn't there? You see this really solid revenue growth. The core business is clearly doing well. But then you look at the bottom line, the profit, and it's taken a pretty big hit.
Right.
And that difference, it's not some accident or market shock. It seems to be a direct consequence of management pushing through a very deliberate long-term strategic overhaul.
Okay, so let's try and unpack that for you. We've gone through all the materials, the investor presentation, financials, press releases, even the earnings call transcript.
Right.
To piece together the full story, why they'd seemingly sacrifice profit now for what they hope is future efficiency, it feels like a case study in corporate renewal, almost.
It really does. It's a classic playbook move, isn't it? Use the strong core business to fund a major restructuring.
Okay, so let's start with that foundation then, because like you said, that part looks undeniably strong.
Yeah, the top-level numbers are good. Total group AUM, that's assets under management, increased by a healthy 11.18% year-on-year.
Which landed where?
22.42 lakh crore as of September 30th, 2025. That kind of growth, it shows pretty solid market acceptance.
Definitely.
And drilling down into the core mutual fund business, their quarterly average AUM, the QAAUM, that grew over 10% year-on-year too,
Okay.
to 3,078,413 crore. And maybe more importantly, the actual revenue engine seems to be ticking along nicely. Consolidated H1 core revenue from selling services was 769 crore.
And that's up how much?
That's up 8% year-on-year. So yeah, the top line is healthy, suggests asset accumulation is working as planned.
Right, but here's where it gets interesting, like you mentioned. Because when you glance at the profit after tax, the PAT, the headline figure is, well, it's a bit jarring.
Yeah, it is. The unadjusted consolidated PT for that first half, H1 FY26, came in at 350 crore. Now, that's a drop of nearly 29% compared to last year.
Almost 30%. For a company growing revenue at 8%, a profit drop like that immediately makes you ask, what went wrong?
Exactly. But what went wrong on the surface was actually part of their long-term plan, seemingly. That sharp fall is largely down to one big thing: a significant, deliberate, one-off expense.
Okay.
It's tied to that strategic employee restructuring we mentioned. They booked a 25 crore provision in the second quarter, Q2, for revised family pension benefits.
Oh, okay.
And that's all part of this newly approved voluntary retirement scheme, the VRS.
So this isn't about the business model failing or sales tanking. It's a controlled financial decision.
Precisely.
So if we mentally strip out that noise, the VRS provision, if we normalize the profit to see how the actual operations are performing, what does that picture look like?
It looks stable, and that's probably the key takeaway for anyone listening. The normalized core PATE for H1 FY26, after adjusting for that VRS item, was 248 crore.
Okay.
Now, that's a modest but still positive 1% increase year-on-year. So it clarifies things, right? The underlying profitability isn't collapsing.
Right.
The reported volatility is almost purely an accounting effect of funding this future streamlining. They basically decided to take the hit now for longer-term efficiency gains.
That's a really crucial distinction to make. Okay, let's shift to margins then. How does their specific mix of assets play into this financial stability?
Well, their mix is quite heavily tilted towards the higher margin stuff. Equity assets that includes both active and passive funds make up a huge 69% of UTI mutual funds' total average AUM.
69%. And how does that compare to the industry?
It's significantly higher. The industry average ratio is closer to 60.40, equity versus debt and other things.
And I assume the yield, the actual earnings rate on those assets, reflect that difference pretty clearly. Can you give us a sense of the margin advantage that gives them?
Absolutely. Their equity and hybrid funds bring in a yield of around 75 basis points, or BPS.
Okay.
Now, compare that to their ETF and index funds. Even though those improve slightly, they still only yield about 8 basis points.
Wow, 75 versus 8.
Yeah.
It's nearly a tenfold difference in margin potential per rupee managed.
Exactly. So that heavy equity exposure isn't just the statistic, it's a financial cushion that's basically funding this whole renewal project we're talking about. So when you've got that kind of margin advantage from your product mix, the logical next step is making sure you have the reach, right? Especially in markets where assets tend to stick around longer.
And UTI seems very focused on that geographical spread.
Yeah, they're really invested in deepening their physical footprint across India, particularly outside the big metro areas.
They operate, what, 255 UTI financial centers?
That's right. And get this. Over 80% of them, 205 centers, are deliberately located in what they call B30 cities. So beyond the top 30 metros.
And that's a strategic choice, presumably?
Oh, absolutely tactical. The AUM they gather from these B30 locations currently makes up 20% of their total mutual fund AUM,
Okay.
which is actually slightly ahead of the industry average, around 19%. And management keeps emphasizing that these B30 assets tend to be much stickier.
Meaning lower churn, people stay invested longer.
Exactly, lower churn rates. And they often come with slightly better margins too, probably because they're built on longer term relationships, not just chasing trends. It's like they're building a deliberate defensive moat there.
That makes sense. And speaking of stickiness and stability, you can't talk about the Indian AMC industry without talking about SIPs, right? Systematic investment plans.
The absolute cornerstone.
That steady flow of retail money.
Yeah.
How's their SIP book looking?
It's not just looking robust, it's looking almost ancient in the best possible sense.
Okay.
The SEP AUM itself grew almost 6% year on year, reaching 42,267 crore. But it's the longevity numbers that really stand out.
Go on.
Okay, so 97% of their long tenure SIP book, these are plans running for a while, has been active for more than 5 years.
97%.
And wait for it, 92% has been active for more than 10 years.
Wow. 92% of people who started an SIP over a decade ago are still putting money in. That level of sustained trust seems like an incredible asset.
It really is a huge competitive advantage.
How do they explain that kind of loyalty in today's market with so much noise and competition?
Well, it probably speaks volumes about the brand's long history and, maybe more importantly, the quality and suitability of the core diversified products they push through that channel.
Right.
Essentially, that longevity translates into a very predictable, almost passive income stream for them. It's highly resistant to market swings or competitor sales tactics.
So it minimizes churn, maximizes long-term profit.
Exactly. And that reinforces their strategic capacity to make these big short-term restructuring decisions like the VRS we discussed. They have that stable base.
Okay, that fits together nicely. Now, let's look towards the future a bit digital. Are they managing to match that traditional strength in smaller cities with a modern digital presence?
Oh, absolutely. It seems their digital transformation is really kicking into high gear. Get this, 89% of their total gross sales in Q2 FY26 came through digital platforms.
89%, that's huge. Is that mostly smaller transactions, or is it capturing the valuable stuff too?
It's capturing the high-value flows. Crucially, for those high-margin equity and hybrid funds we talked about, 41% of the gross sales in the quarter were mobilized digitally.
Okay, that's significant.
Yeah.
It shows that the digital channels aren't just, processing the small stuff. They're bringing in serious AUM.
Precisely. And the convenience factor is clearly resonating too. The number of digital purchase transactions jumped almost 18% year on year,
Wow.
reaching over 52 lakh transactions. So yeah, they seem to be successfully bridging that gap, leveraging the traditional stickiness from places like B30 cities, while also meeting the demand for fast, easy digital access from likely a younger investor base.
Okay, this brings us neatly to that core strategic pivot you mentioned, the corporate renewal piece. You can't really undertake a financial cleanup like this without some changes at the top, can you?
That's right. And we are seeing a major leadership transition announced. The current MD and CEO, Imtaizur Rahman, is set to transition out.
Okay.
And Vetri Subramaniam has been appointed as the incoming MD and CEO effective February 1st, 2026. So that really signals a formal shift, a move into the next chapter for the company.
And the VRS, the Voluntary Retirement Scheme, that seems to be the main tool driving this change on the ground floor. We know about the 25 crore provision that hit the books, but what's the strategic point of spending potentially a lot more to let people go?
Yeah, the VRS appears to be very much aimed at strategic workforce rejuvenation. There are 479 employees eligible. That's roughly a third of their total staff.
A third. Okay.
And the goal seems twofold. First, internally, they want to improve the structure, specifically maybe boosting the ratio of frontline sales staff, the hunters, as they might call them, relative to supervisory roles.
Right, making it leaner, more sales-focused.
Potentially. And second, it frees up both budget and organizational space to invest in, presumably, a younger cohort, people perhaps with different skill sets, more aligned with the digital growth we just talked about.
So it's a big financial chess move then. Take the P&L pain now, to create a potentially fitter, more agile workforce for the coming years. How's the timing structured for the full cost? You mentioned the Q2 provision.
Right, that was just for the pension liability adjustment. The main hit, the total cost of the VRS itself, which is substantial, they estimate an average of maybe 60 to euro 65 lakh per eligible employee. That whole chunk will be charged to the profit and loss account in Q3 FY26.
Okay, so the next quarter's results will reflect that big cost.
Yes, but here's the clever part, accounting-wise. While the expense hits the P&L in Q3, the income tax impact of that massive outlay will actually be amortized, meaning spread out over 5 years.
Ah, interesting. So they get the immediate restructuring benefit, but smooth out the tax pain over a longer period.
Exactly, and maximizes the short-term operational benefit while kind of minimizing the immediate tax shock. Pure long-term planning.
It has to be. This kind of expensive renewal must be aimed at achieving some very clear strategic goals. What's the incoming CEO, Vetri Subramaniam, signaling as the focus areas?
He's articulated 4 main priorities based on the commentary. First, a significant push on brand visibility. They want to reconnect the UTI brand, especially with younger investors who might not be as familiar with its long legacy.
Makes sense in today's market. What else?
Second, a continued focus on growing their SIP market share, specifically in those core diversified products. That feeds right back into the long-term loyalty and sticky assets we discussed.
Right.
Third, really doubling down on the hybrid category. They specifically mentioned their Balanced Advantage Fund is approaching that crucial 3-year track record milestone.
Which is a big deal for getting onto rating platforms and approved lists for distributors, isn't it?
Exactly. It unlocks wider distribution. And the fourth point is interesting. It touches on that conservative nature. They acknowledge their historical, maybe cautious approach towards launching lots of sectoral or thematic funds might have cost them some gross sales recently and maybe impacted their short-term SIP book share compared to competitors chasing those trends.
Right, that does create some friction, doesn't it? We need to dig into that. If the goal is growth and renewal, how can management justify not chasing those easy high-inflow funds that seem so popular right now?
It seems to be a very deliberate, calculated trade-off. They're choosing between, let's say, market share velocity growing fast now and the long-term quality and stability of their assets.
So they know they're leaving some growth on the table?
They explicitly acknowledged it, yes. Avoiding those potentially high growth but also high volatility categories like sectoral and thematic funds has impacted short-term sales figures. But their underlying philosophy seems clear.
Should just.
Prioritize long-term SIP sustainability and maintaining investor trust in their core diversified offerings. They seem wary of chasing hot flows that might lead to investor disappointment and high churn when market sentiment inevitably turns.
So it's the disciplined, almost institutional approach. Focus on surviving and thriving over decades, not just winning the current quarter's AUM race.
That's certainly how it comes across. They're essentially betting that asset longevity and predictability will prove a more valuable competitive advantage in the long run than simply having the fastest AUM growth today.
Okay, to get the complete picture, we probably need to look beyond just the mutual fund business.
Yeah.
Right, at the subsidiaries. They act as important diversification pillars.
Absolutely. Let's start with the pension business. That's historically been a real stronghold for UTI.
And is it still?
Oh, yes. It remains a major strength. UTI Pension Fund Limited manages a very substantial chunk of the overall national pension system. The NPS, about 24.62% of the industry AUM.
Wow, nearly a quarter of the entire NPS market.
Yeah, it's significant. And the subsidiary itself saw really strong growth, nearly 16% year-on-year AUM growth, 15.82% to be precise.
Healthy. What's the focus going forward there?
They're looking to launch 4 new schemes under the PFRDAs. That's the pension regulator's new multi-scheme framework. This should give them more options to attract funds, especially maybe from the private sector side of MPS.
Okay. And what about the more sophisticated end of the spectrum, alternative investment funds, AIFs?
Right. UTI Alternatives, they're quietly building up a pretty serious book there. They currently have active commitments totaling around 2,669 crore.
Okay.
And they seem to be executing a clear strategy to diversify across different types of credit investments. For example, they launched a structured debt opportunities fund for fee back in August 2025.
So this provides different, perhaps higher yielding avenues compared to the main mutual fund business.
Exactly. It's a distinct offering catering to maybe more sophisticated or institutional investors.
Got it. Finally, let's touch on their international presence. How's the global side of the business doing, especially given the current market environment?
Yeah, UTI International manages a respectable AUM of about USD 2.66 billion, but unfortunately, they face some pretty significant headwinds in the first half of this fiscal year.
Okay.
They actually saw an 8% year-on-year decline in their sales of services for H1 FY26.
Ouch. What's driving that decline? Is it something specific to their performance or broader market factors?
It seems to be largely macro factors based on management's commentary. They mainly attribute it to a general cooling of foreign portfolio investor or FPI sentiment towards India right now.
So foreign investors pulling money out of Indian markets generally.
Yeah, that's a big part of it. There are also some fund maturities. Think of things like fixed maturity plans expiring and just the standard impact of mark-to-market changes on their existing holdings. The global capital flow just isn't aggressively rotating into India at the moment, and that's hitting their international sales.
Okay, so their strategy internationally is probably focused on weathering this period and being well positioned for when that capital flow eventually rotates back towards India.
Precisely. The narrative is very much about focusing on quality growth, generating alpha investment outperformance, so they are attractive when global sentiment does turn positive again.
Makes sense.
And just one final note on their product pipeline internationally. They're taking a typically cautious UTI approach to launching new things like special investment funds or SIFs.
How so?
Well, the product structure itself offers flexibility, but they're deliberately delaying the launch until they're sure their distribution partners have all the necessary regulatory certifications to actually sell the product properly.
Ah, classic UTI perhaps. Compliance and readiness first, speed second.
Seems to be the pattern, yeah.
Yeah.
Hashtag #HowTrotro.
Well, this has been a really fascinating look under the hood at corporate strategy in action.
Yeah.
If we try to boil down the key forces shaping UTI AMC right now, it really seems to come down to two main things.
I agree. First, you have that undeniably robust, high-quality core asset growth engine.
Right, built on the back of those B30 cities and especially those incredibly sticky, long-duration SIPs.
hmm And then second, you have this significant but clearly deliberate short-term hit to the profit line.
Yeah, resulting from that expensive but, in their view, necessary strategic decision to clean house via the VRS, transition leadership smoothly, and position the company for a younger, potentially more efficient future.
It really is a textbook example of corporate renewal, isn't it? The company is consciously accepting short-term financial pain booking, that big VRS provision, to invest in perceived long-term benefits.
Like a rejuvenated workforce, better digital capabilities, maybe a refreshed brand focus.
Exactly. Which leaves us with a really interesting provocative thought for you, the listener, to mull over.
Okay.
UTI AMC is actively, consciously choosing to stick to its disciplined, conservative path. They are avoiding the high-flying sectoral and thematic funds that are sucking in huge amounts of money for some competitors right now.
Right, they're prioritizing that long-term SIP stability and maybe brand trust over chasing the fastest possible market share gains today.
So the question is, given all the talk about increasing volatility in the global macro environment, is this patient, disciplined approach actually the ultimate strategic advantage? Does it give them an edge against potentially higher-risk competitors in the long run?
Or
Uh,
are they deliberately missing a crucial near-term window of opportunity to really cement their leadership position while those flows are hot?
It's a great question. A strategic gamble, really.
And one that only time and probably the next few quarterly reports will begin to answer. That's all the time we have for this deep dive.
Thanks for joining us.
We'll catch you next time.